Hey, welcome everybody. It's February 10th. Welcome to the clinic, Santa Cruz Works clinic, Dear Prudence, GameStop, hedge funds, and Thanos. We have a wonderful guest, Thomas Wynn, who will be talking to us today. And let's get some housekeeping out of the way real quick here. There you are. Hey, how you doing?
See me, hear me?
Yeah.
All right. Okay. Hello, everybody. I am Thomas Wynn, CEO of Wynn Capital. And let's see. There's my info. I started this company in 2003. I managed 63 million for 75 clients. My social media is there and my contact info, and that'll be at the end. And as Doug said, the material is going to be available to replay. And if anybody wants this stuff, they can contact me. I'm going to go through some slides pretty quickly, and I'll just touch on the title. First of all, Dear Prudence is a reference to a Beatles song. I've just found out that a lot of young people don't know that. And I'm appealing to a prudent, and I'm going to argue for a prudent investing strategy. And then the GameStop and hedge fund is in the news, and I've been asked to weigh in on that. And I'm basically going to just answer your questions about that and see if I can enlighten you on that. And the Thanos reference is, Thanos is the villain in the Avengers series, and his catchphrase is, I am inevitable. And there are a lot of things in investing that are inevitable, mostly the frailties of the human emotions that make us all do pretty silly things. So we could go to the first slide from there. This is a little illustration of why humans are not really meant to invest. It's really counterintuitive. And I've spent many years, starting in '81, as a runner on the floor of the exchange, and then as a trader, and now as an investment advisor for 18 years or so, learning how to try to overcome some of these. And I don't always, obviously, but these are the mistakes that we all make. And you can go to the next slide. And the media doesn't help. The media is free for most people, and they're just trying to sell ads. So they're not really spending a lot of time on financial literacy. They're really doing the opposite. They're trying to get you to do things to help the industry and their bottom line, but not yours. So you could go to the next slide again. And this is some of the reasons why people invest. They get tips, or they heard it on the news, or they read subreddit or social media or some other reason. And without a lot of due diligence, they will put their money to work and basically speculate. You could go to the next slide. And this is an illustration of the emotions that we all go through. When the market's going up, we have these periods of elation, and there's a group of people that will take their cash and buy stocks at that point. And then when it goes down, they get nervous and they capitulate when they have enough fear, and they sell their shares at low prices after having bought their shares at high prices. And so for the certainty of cash and to get rid of what has probably become, some days, months, or even years of low prices, that group that buys at high prices and low prices can always be counted on. It's one of the inevitable things. And they run out of money and are replaced by other people that are basically unable to endure the declines in the stock market. There's another group that changes places with them. They sell their shares at high prices and they buy their shares at low prices. You can go to the next slide. So this is part of the argument about, I don't like to say stay the course or buy and hold or that, because you have to be relatively active and stay in tune. But there are certain things that are evidence for why you should not stock pick or market time. This is a argument against market timing. And if you hold everything for that period that's on the slide from 90 to 1930, about 30 years, if you hold everything every day, you're fine. You get 9.9%. The next bar on the right, if you miss just one day out of 30 years, your returns will go down about 5%, from 9.9 to 9.5. If you miss 5 days, it goes down even further, et cetera, until if you just miss 25 of the single best days out of a 30-year period, your returns are cut in half. And so it's a lot of people have overconfidence that they can be in on those days and out on the bad days, but the data shows that that's not the case. So next slide. This is a little bit basically a similar story about stock picking. So if you hold all stocks, both the winners and the losers, over time, and you see the time period in the slide, you can get about 8% over that time period on an annualized basis. If you miss the top 10 performers, you're a stock picker and you put together a portfolio of the things that you think are going to be the best going into the future, and you miss the top 10%, your returns are cut in half. And if you miss, 25 top performers, you'll have negative returns, which implies that the majority of stocks went down and only a few were responsible for the gains. Next slide. This is a thing that people like me look at all the time, is the dispersion of returns across asset classes. And it's showing kind of color coding the things that were the winner of each year versus the losers, the best and the worst returns. Now, everybody in the world and people with tons of resources and expertise tried to predict what this pattern is going to be, and no one seems to have succeeded in that, at least no one that has published their results and their system. And I've tried early in my career to predict what asset classes would go up and down, and I didn't succeed. And then I went to a more of a globally diversified long-term hold. And you can go to the next slide, Matthew. This is an interesting slide because it's kind of intuitive in one sense that positive returns are 74% of the time, and negative returns are 26, which is, why do we invest? Well, we can get much better returns than a CD or something super safe if we invest in the market, but we do have to endure those 24 or 26% of the years that are negative. And that is very hard, even for hardened, experienced pros like me. It's hard to hang in there. But this is not in chronological order. So it's like, well, let's just make the bet to hold stocks. But when those red squares show up, it's very hard. You can go to the next slide. This one is a little bit about hanging in there during a crisis. And these bars are 1 year after a crisis, 3 years after a crisis, and 5 years after a crisis. And it's got, on the left is the October 1987. A little bit of trivia is that I was a self-financed trader on the floor of the Pacific Stock Exchange that day, trading my own account. And I was 3 months, had about 2 years of experience, but had just gone on my own with my own capital. So I was losing my own money that particular day, but I just lost a fraction of what I'd made in the first 3 months. So I survived and went on. And then all the other crises that have happened, and it doesn't have the last year's pandemic crisis, but we're up about 70% from the lows in about a year from that point. You can go to the next slide. And I anticipate someone might ask me what my opinion of the current market is, and should we buy, sell, or hold? And this just illustrates that we're overvalued, but no one really has an idea of when the overvaluation will stop and we'll go back to fair value, either by going sideways for a long time or going down sharply to get back to a normal PE or a fair value PE. But the market can stay overvalued for irrationally long periods of time. So I don't jump in and out. We just stay on our target allocation, whatever that is for the client. Next slide. So in the stock market, people look at a stock and think that it's improperly priced, and they buy it or sell it based on their opinion of price. That price has been arrived at through a supply and demand and the interpretation of all the available information by a lot of smart people. It doesn't mean they're infallible. And 2 seconds later, new info comes through. So new information is constantly creating volatility in prices, but the current price incorporates everything that's known up until that moment. We're all making assumptions about futures, but you go into the grocery store and you believe the price. You're not really speculating that something's going to go up or down, but people do that in the market all the time. Next slide. Really the same thing about one of the previous slides about no matter what happens in the market, it's got a bias going up. Relatively short periods of lower prices that is accompanied by really terrible news. But unlike every other area of life, when stocks go on sale and are at lower prices, people flee. Of course, there are a category of people that have the willpower to buy at low prices. But you just have to endure these low prices if you want to capture returns. Next slide. This is another one that kind of makes it easy. We overweight in our portfolios value stocks over growth, very slightly, not enough so that when we're wrong, we get fired, but enough to try to capture what we call dimensions of expected returns. And since value outperforms growth, the bars on the right versus the bars on the left where value underperforms, we try to capture that. And historically, we've captured a little bit of outperformance due to this dimension of expected return. But if we go to the next slide, this puts the returns in chronological order rather than grouping them. And this is a lot more difficult. Over the last 10 years, value has underperformed, which is kind of common. If you look at the current underperformance by the bars below zero on the right, and then you look at the late 2000 period where we had the tech bubble. During periods of speculation, growth stocks outperform value, and then it goes back, reverts to its mean. So it's harder to endure these long periods. And again, if you have a all value portfolio, you're going to have a difficult time, but we just tilt our portfolios rather than massive overweighting. Next slide. And this is a little complicated. It just looks at 4 areas that stocks do better than bonds. That's the top column or row. And then small does better than large, value does better than growth, and high profitability does better than low profitability. So we tilt our portfolios again in those directions, dimensions of expected returns. You can go next slide. Again, this is I'm making an argument for a globally diversified portfolio. Many Americans and most people overweight their particular country. That's called a home bias. We are globally diversified, and this implies that we're killing it all the time because it's a long period, and a globally diversified, which is the top line, does better than the S&P 500. But if we zoom in, which is the next slide, the performance is still, over this particular period, was still better. And then let's go to the next slide. Here we are in the current period. It's not all the way back in 18, but I think it's still the case. It started to turn slightly. It's very hard over this period to maintain and capture long-term outperformance when you have short-term, and in this case, it's 8 years. After 8 years of underperformance, people start to complain. But we tried to make the case that it will turn. And again, it's a tilt. It's not a massive overweighting in one area or the other. Next slide. So in a nutshell, you guys can read this for yourselves. Here's what we do. Really knowing the client when you're an investment advisor, and if you're self-directed, knowing yourself and what you can tolerate as far as losses. We do a hard work of trying to understand what our clients could tolerate. And then we try to build a portfolio, we diversify, and then we control what we can, the expenses, the turnover, the taxes, and we try to stay strong emotionally when prices are low. Next slide. This is basically, how I allocate my portfolios from 100% equity to 100% fixed income, and the asset classes that we use. We use a mix of DFA funds, Vanguard funds, and other ETFs, and some other companies that we need. But if you wanted to self-direct, you could put together a portfolio at any risk level using that. You can't use DFA because you have to have an advisor, but you could find a DFA advisor, or you could use Vanguard funds or other good fund companies and put together your own portfolio. Next slide. That's my contact info. And now I'm going to turn it over to Matthew and see if there's any questions that came up on GameStop and hedge funds and SPACs. And I'll try to do my best at answering those questions.
Great. Thank you so much, Thomas. So yeah, we do have a few questions. If you have a question for Thomas, please put it in the Q&A and we'll be able to answer that question. One question, just to get it out of the way, will your can you email them the slides? It will actually be on our website tomorrow with the video. So if you missed any part of this video, go to santacruzworks.org, and in the news highlights, you will see this video plus the slides. Okay, first question. What firm do you recommend for individual traders?
I prefer TD Ameritrade. TD Ameritrade has a retail side, which individual traders can go to, and they have an institutional side, which is where I run my business. And they have great products and services. And the thing about TD Ameritrade is that they don't have a conflict of interest. They are going to merge with Schwab, and Schwab is fine, but Schwab is a mutual fund company, and they're going to promote their mutual funds above DFAs and Vanguards or other companies. And sometimes that might be good, but other times it might be bad. So for now, probably for the next year, TD Ameritrade is really the only place you can go in the big firms that don't have a conflict of interest, like Fidelity and Schwab. And they have great software and other products for individual investors.
Okay, great. Next question from Dagmar. Thanks for all the valuable insights, Thomas.
Mm-hmm.
If you have a client who is also interested in investing in real estate, in addition to the investment tools you mentioned, how do you approach that, and do you help a client find the right balance?
Well, most of our portfolios have a real estate component separate from the mutual funds. We have an alternative investment that we use for real estate exposure, but it's very specific to each client, whether they can tolerate that or want that or qualify for that, because the alternative fund we use is only for accredited investors. But we do use dedicated real estate funds for exposure to real estate. So almost any company, Fidelity, Schwab, Vanguard, will all have dedicated real estate funds. And again, I'm making the argument that a diversified portfolio of funds is a better way to go. We actually own a loan portfolio, a bridge loan portfolio for most of our clients that is appropriate for.
Okay, great. Next question. What percent of cash would you hold now, given the market appears overpriced?
2%.
Okay.
My cash in general, my cash allocation is 2% in all markets. We're in diversified stocks, bonds, and mutual funds. I'm only moving right now. I'm not doing much with the stock portfolios other than rebalancing them. So on the stock portion, as the market goes up, our stocks allocation gets bigger because stocks are going up faster than bonds. So 60-40 portfolio might grow to 65-35 or 70-30 because our stocks are going up faster. And then we sell those stocks in rising prices and we buy bonds. I am reducing the duration of my bonds because long bonds have a lot of risk at low prices, but we keep our money working. Bonds historically do better than cash, stocks do better than cash. And it's a market timing question. Do I want to raise cash because I think the market's going to go down and cash will outperform. We might temporarily hold high cash as I'm sell long bonds or stocks and wait a second to see if interest rates go one way or the other, but for very short periods of time in general. But no, we're just always trying to keep low cash.
Okay, thank you. Next question. How would you compare mutual funds versus ETFs? Which one to choose under which circumstance?
This is a little contradiction. I started with all ETF portfolios, and ETF's main attraction for me is that they trade all day long. So I have a bigger opportunity set of prices that are available to me during the day than the single price at the end of each day that mutual funds are. But for practical reasons, we use mostly mutual funds. And I use a strategy when I have new money that I want to put to work during the day, I'll use an ETF that's equivalent to the mutual fund and then switch to a mutual fund. So it's a complex question, but our portfolios are mostly mutual funds and not ETFs, although DFA and Vanguard have both started to produce ETF versions of their mutual funds. Vanguard sooner than DFA, but DFA is starting to do that. And Dimensional Fund Advisors is a mutual fund company that is huge, but most people don't know about it because it's only available through investment advisors. And it's the company that I use primarily. And so I prefer ETFs if they exist, but it's not available in all asset classes that I want to use. And when it does, we probably go to an all ETF portfolio.
Okay. Okay, Leon has a great question. How do you explain the current rally of stock market, which doesn't seem to pay attention to the economy being affected by the pandemic?
I can attempt to explain it, but there's a lot of things that it's a little bit about what I talked about at the beginning. When you look at a price of a stock, or you look at a chart of a stock, or the market in general, those little dots and those prices are just a reflection of human actions. It's just people. And it's kind of irrational for stock prices to be at high prices right now relative to the economy. But it's kind of a saying for all of us in the profession. It's like the economy and the stock market are disconnected, obviously. They are now, they always have been. The economy is current and it's reality, and it's not really human emotions can't change, whether you've got a job or whether your business went bankrupt. So there are certain things that are reality. The stock market is a collective vote by people. There's a saying that in the short run, the stock market is a voting machine, which we've just experienced. Voting is highly emotional and subjective, but in the long run, it's a weighing machine. It's like we can argue about who won an election or who should win or who doesn't win, but the weight of something, well, at least in the past, if you said something weighed 2 pounds, you put it on a scale, you could get everybody to agree. I'm not sure that's true anymore, but it's just human emotions. People believe that in the future, because of the Fed and many other factors, that this price is justified. But a lot of times momentum investing or speculating or just pure irrational exuberance, and prices get out of whack. And you have to be aware of that. Guessing that it will correct anytime and putting a timestamp on that is where people go wrong.
Okay, next question. How do you assess the risk of Bitcoin?
I don't.
Good answer.
If there are futures in Bitcoin, and so you can trade Bitcoin, but futures are not an appropriate way and not an efficient way to invest in the long term. Futures have inefficiencies that can lose money over time due to contango and volatility or premium decay. So, but when there are ETFs and mutual funds or some instrument that is a good way to invest in Bitcoin, I would probably, and Bitcoin falls in price, I'd probably buy some for appropriate clients. But I don't understand. I am a fan of blockchain technology. Last I checked, there was 5,392 cryptocurrencies, and maybe one of them, and maybe it's Bitcoin, will succeed and become a currency like all the other currencies. But it's hard to tell what's going to be the winner, but the blockchain technology, of course, I think is going to be adopted and used for all kinds of different purposes.
Okay, thank you. What software would you recommend for trading?
I use for my personal trading Thinkorswim, which is through TD Ameritrade. And for people that are, I don't think it is, for most people, if you're going to put real money or your retirement into active trading, it's not a good way to go. Most people have a poor outcome. And but if you can't help yourself, a better place to be is TD Ameritrade, where you don't, or TD Ameritrade or Thinkorswim, and not paying fees. A little bit about the Robinhood. Robinhood has no fees and a great interface, but they sell your order flow, and so you don't get good prices. You pay a lot more in bad prices, but it's so non-transparent that the illusion of no fees is enough to attract a lot of people. And you'll pay fees at TD Ameritrade and Thinkorswim, but they won't cheat you when you go to get your, put your orders out in the market. So yeah, Thinkorswim, and there's a great, there is a website for people that really want to trade and learn from people that aren't cheaters, but are real professional traders, called shadowtrader.net. Is a chat in Thinkorswim, and I listen to that broadcast when I'm putting money to work, and they're real guys that do real trading. I think it's got somewhere between 1,000 and 2,000 people on it every day, which is dwarfed by the Reddit crowd. But and even in that crowd, I don't think most traders there make money. My guess, even though they're getting good advice and good training. But that's my recommendation, is using those two.
Great, thank you. Okay, so here's a hot topic on SPAC investors.
Okay.
Do you have a philosophy or a potential for any potential SPAC investors who see a decent blank check shell based on disclosures, but don't have the capacity to move quickly? For example, could buy and hold work in a SPAC world?
You guys saw, I put an article on SPAC, the New York Times. SPACs have been around quite a while. They're hedge funds, which I'm not a fan of hedge funds. Again, hedge funds in general lose money for their investors and make money for the creators of the hedge fund. A hedge fund in general gets 20% of profits and 2% management fee. And I charge 1% for my management fee, so I'm jealous of those guys. So they get paid 2% no matter what happens. And if it goes up, they get 20% of the profits. So you're paying 22% load before taxes. It's a silly proposition that you could make enough money to overcome those fees. So a hedge fund's not a good way, and there's data, if you Google it, you figure out what the average returns are for hedge fund investors. They're bad. But the few winners, of course, the media promotes a few winners, just like the lottery winner. And SPACs are hedge funds, only worse. There's an article that I just put on my Twitter feed at Wynn, and they reduced the regulations on who can invest in a hedge fund, which used to be accredited investors with over 1 million. So the people that were underperforming and getting ripped off were relatively rich people. But I think SPACs are trying to take advantage of opening up speculative investments that are tilted in favor of the sponsors. And everything about a hedge fund is true even to a greater extent in the SPACs. So some SPACs will do great, probably a small percentage of them, and some investors will profit, but the incentives and the structure are really bad for most investors. But there's a pretty in-depth article on my Twitter feed from the New York Times, and you could find lots of information about SPACs online.
Okay, thank you. And again, there's so much great information that we're getting here from this clinic. If you're missing any portion of it, go to Santa Cruz Works tomorrow, but it will be in our news highlights section, so you can watch the whole thing. Next question: what mutual fund companies do you recommend?
I told you dimensional fund advisors, but you have to hire an advisor to use them. They don't pay us to recommend their funds, but DFA, Dimensional Funds, doesn't from the beginning, and they're about 30 years old. They're founded at a similar time as Vanguard. And they're basically index investing with a little active component that I talked about of overweighting certain things. So you have to find a DFA advisor, and you could go to their website and find a DFA advisor wherever you are. And Vanguard is the next best thing. Vanguard, and I'm a big fan of target date funds. They're, competition for me. Both Vanguard has advisors that you can use, and their target date funds are a single fund that if you just put your age in, it'll just do all the work behind the scenes of, rebalancing that you won't have to do, and it'll have all the components. You just have to figure out your risk level. But there's other good fund companies out there, but those are the two that I mainly use. And like I said, I use ETFs from all the different providers. ETFs in general have lower fees. Vanguard and DFA have fees that are about 90% less than Fidelity. So I like them better.
Okay. Next question, also from Leon. What is the place of life insurance in financial planning? Is it always true that buying term insurance and investing in the difference between whole and term policies is always better than buying whole life insurance?
That is a question for your insurance agent. I do financial planning, but I farm out to other professionals the insurance part of it and the estate planning and the taxes. So I don't do taxes or estate planning. I just work with other professionals. I do the investment part of it, and then we, as a team, put together the estate and insurance. So that's an insurance agent question. I can't answer that.
Okay, thank you. Next question. Is there an active trader broadcast that you follow?
Yeah, I told you that's the shadowtrader.net. You can get it through, you can access most of the material through the website, but the daily broadcast that goes from the opening, a little bit, 15 minutes before the opening until the end of the day, is on the Thinkorswim website. It's one of the chat rooms in the Thinkorswim website. So I think you can only get Thinkorswim if you have an account at TD Ameritrade, but you don't have to put any money in the account. You can open an account there with no money and then download the software for free and then use it, navigate to the chat and find Shadow Trader. Like I say, they're pros and they don't overpromise, but they're trading in real time, and it's educational and helpful.
Okay, thank you. And thank you for John for putting a couple of questions from the chat into the Q&A. I'll ask one of them right now. What is your opinion on E-Trade?
It's kind of a general question. I'm not sure, E-Trade's fine, I think. E-Trade is similar to TD Ameritrade if they were, going for self-directed retail investors. And, I'm making the argument that day trading or active trading is not successful in general for most people. And so TD Ameritrade has a lot of active investors, and so does E-Trade. So I have mixed feelings about it. It does give you access to a lot of information. And if you wanted to put together a self-directed, really prudent portfolio, you could, but there's a larger contingent of people that misuse it and overtrade and speculate and day trade and have bad outcomes. So TD Ameritrade and E-Trade are similar in that they were the precursor of Robinhood. They were going down market into lower cap people with less money, and Robinhood's just taken that to the nth degree and allowed the purchase of fractional shares and options trading for people that shouldn't be doing it. But I think E-Trade's fine.
Okay. Next question. And I might have a little bit of ignorance on asking this question. Would you compare the GameStop situation with the tulip craze from the 17s? Is that 1700s or is that the 70s?
Would I, or could I, or?
Would you compare, it says, yeah.
So yeah, there's a speculative frenzy or a bubbles, whatever you want to call it, where, it's I've been working full time since 81. So I've gone through the 87 crash, the 90s tech bubble, the real estate crash of 7-8, and the current high price. Some people are calling this a tech bubble, and some stocks are obviously overpriced. The S&P is about double what its fair value PE is. And so, yeah, there's speculation, momentum investing, crowd, people that shouldn't be in it are in it. So yeah, there's some similarities. I'll touch on that since we advertise it, we talk about it. I'm familiar with GameStop because there used to be a store in our town. I live in Ben Lomond, and in Scotts Valley there was a store. It's bricks and mortar, selling cartridges and other game paraphernalia. And my son was a big fan. We would go buy stuff all the time, but it closed as everything went to the cloud. And it got revived, I think, before the speculation started, a guy that started the Chewy company, I believe, the dog food and pet food company, made a bunch of money and then bought, I think, into GameStop, thinking that he could revive it and update it and make it a going concern again. And that gave the kernel of a premise that the stock could be worth more than its current price. And as I think everybody knows, that when a company looks like it's going to go bankrupt, short sellers, hedge funds, and other traders all across the industry short the stock, which is borrowing shares from somebody that owns it and then selling it, trying to buy it back after it falls and making the difference between the sell price and the buy price. Just the inverse of buying something and selling it at a higher price. So there's a lot of details about short selling that are too complex to go into, about margins and the infinite amount you could lose versus the finite amount you can lose. Zero protects you on the buy side. Things can only go to zero. And what the short sellers, both the hedge funds and the individuals that were shorting GameStop, found out is that it can go from 5 to 500 in a short period of time, and often with gaps, so that you could sell it one day and the next day it would open at a price astronomically higher, and you would either have to absorb the losses or come up with the cash. But that happens every day of the week in the industry, and the fight is usually between individuals, investors of one group or another, or often mutual fund companies and often hedge fund companies get into the news about fighting about whether a company is worth something or worth nothing. And they will try to jawbone in the media their position and try to get one side to capitulate. So that all happened. The only thing that I see unique about it was the people that were on one side were part of a social media group to some extent, although there were a lot of professional traders and hedge funds on both sides. Everyone's talking about the Reddit group was the only people that were long the stock, but there were lots of other people, including, it's my assumption that professional traders and hedge funds were in the buy side of that trade. They were just experienced, highly capitalized, and had way more information than a lot of the people that didn't have that experience or resources. So there was hedge funds on both sides. When that started to come out, I wrote a note that I didn't publish, but I wish I had, which is, I have a saying that if you get in the ring with Mike Tyson, you might lose an ear. And some people might not know who Mike Tyson is. We all get older. Doug and Matthew and I were joking about Beatles references and other references. But Mike Tyson was a boxer that bit someone's ear off when he was boxing. So it just illustrates you're dealing with other people on the other side of the trade, and a group of Reddit investors versus a group of hedge funds will ultimately lose. They might have win a battle, but they'll lose the war. And I know one hedge fund did lose a lot of money at least, but at the end of the day, it's people with more money, more resources, more talent, and they know the rules and the regulators and access to capital. So it was an unfair fight that I think is, I don't know if it's over yet, but unfortunately, a lot of people lost real money and their lives are going to be affected. And the one thing I impress upon my clients is the gravity of the situation that I'm in when I take responsibility for someone's investments. And self-directed people sometimes make mistakes, or the industry encourages them to make mistakes, or Robinhood and other factors allow people to do things they really shouldn't do. But there are real consequences, and there's going to be a lot of people that suffered from that. So it's not a funny thing to me. I think a lot of people are really hurt by it.
Okay, we got 2 more questions here. What about Ray Dalio's opinion? I hope I'm saying his name correctly, that we are going towards once a generation change in the economy's ability to bounce back within a couple of years after the overcorrection. Any thoughts on that?
I'd probably have to, I don't really understand the question that well. I know that name, and I've read his material. I don't know that person. I can't remember if it's a mutual fund guy or a pundit. If the questioner wants to contact me through my email, I could answer, but I don't really understand the question, whether they I couldn't tell if the questioner thinks the market's going up and it's going to keep going up, or is ready to fall. I didn't really understand it that well. Did you, Matthew?
No, so that is a good idea. If you want to contact Thomas directly, I think that would be great. And we'll, at the very end, we'll show his contact information as well. Okay, so last question. What is your perspective on the use of annuities?
I don't personally use annuities in my business in general. Annuities have high prices and low returns, and are not transparent. But there are a category of new companies that are offering annuities that are much better. I think I'll be offering annuities in the future, but currently I'm not using them for all the reasons that I just said. Just a high costs and lack of transparency.
Okay, great. Oh my goodness, Thomas, this was an amazing amount of information in just a short period of time. So we really thank you so much for this hour. I think I'm gonna give it back over to Doug now.
All right, thank you guys.